Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca, Canada's first online financial news and research service providing insider news and knowledge to investors. Welcome back to the show, Ted, and best of the season.
Well, best of the season to you, Jim, and all your listeners.
Ted, how have the U.S. markets performed this year, and how do you think they're going to do in the new year?
Well, it's been a really good year for the U.S. market, and that a lot of it, I think, had to do with, ironically, the mini bank crisis we had in the beginning of the year, or late winter, where, if your listeners will remember, Silicon Valley Bank went under, had to be rescued, and that allowed the Fed to come in and do some stealth quantitative easing. They didn't call it that, of course. They called it something like the bank term funding lending program, or something like that. Anyway, and they'll have to actually decide whether they're going to renew that program next March, because it was only for 1 year. But basically, they allowed the banks to basically, if they had money losing treasuries on their books, they could just lend it to the Fed, and at full value and get cash for that. So it was a nice program that was called the Bank Term Funding Program, right? So that is basically a very nice type of program that that no American citizen can get, but if you were a bank, you could basically get full value for your underwater investments, and isn't that nice? So that was kind of the stealth QE, and the thing that helped, that was sort of April-ish, and March, April, that program got underway, and that kind of got everyone, I think, thinking, oh, is this like Bernanke is back? Bernanke 2, we're back to the days of the great financial crisis, where the economy is going to be on the ropes, and the only game in town is the Fed. And this really kind of gave tech stocks a boost, and it coincided with the AI narrative and NVIDIA that came out with surprise earnings, and so it really kind of gave the NASDAQ a juice, and everyone kind of forgot about resources, but rushed into U.S. tech stocks as they were dumping bank stocks. But of course, the indexes like the S&P 500 are so heavily weighted towards tech stocks that it really gave the U.S. broad indices a big lift in that kind of unexpected dynamic that, in terms of heading into the year, but that was what was playing out kind of mid-year. And we all had to, in the resource market, had to sit and watch while, we had this AI craze juiced by Federal Reserve intervention once again. However, the bank stocks at that point became very depressed, but they came even more depressed, especially some of the money center banks later in the summer when the Fed decided it was going to raise rates again, and that really kind of hit us by surprise, thinking that they're not really going to do this, are they? And we saw some money center banks starting to hit new lows for the year. So this was like after the Silicon Valley Bank experience. the Fed actually managed to kind of say, well, we're going to, risk doing another major policy mistake here and raise rates again. So this kind of got the markets in the U.S. a bit more shakier in the end of the year, towards the end of the year, not right at the end of the year, but sort of September-ish, and we began to think, no, the Fed, this is too much. The Fed is not going to be able to keep this pro in high rate for longer narrative going. They've blown it here. I mean, you don't see these big money center banks this week without something going on in the Fed. If we can see it on our screens, we're sure the Fed and policymakers in the U.S. could see it on their screens. So fast forward, Jim, to December, what happened? The Fed decided they were going to pivot. They didn't want to head into 2024, with a potential bank crisis too on their books. This is our view, and that's why Jerome Powell, in our view, decided, no, we're done hiking rates, and if anything, we're going to be cutting them. 2024 also happens to be an election year, and we just think the Fed didn't want to kind of be in the mix in 2024. There's going to be enough on the agenda in the U.S. for Americans to deal with. They didn't need another bank crisis engineered by the Fed, so the Fed decided to go a bit easy. Didn't want to sort of be able to be pinpointed for another crisis, another recession. It's really up to the Fed to kind of step aside, not inject itself into the public discourses during an election year, and let the politicians fight it out. So they may actually cut rates, we think, early in the year, front load them. We'll have to see. It's not that the American economy really needs it, but it's a financial system that is highly levered, and the Fed may have gone too far for the financial system. We'll have to see how that plays out. But the big idea here, though, is the Fed has finished hiking rates. We're actually, we were very upbeat on the U.S. financials last year. During 2023, and we actually upgraded it based on insider sentiment because a lot of insiders were buying. We upgraded in the spring, but we're looking at sort of bringing it back to what we call sort of a fair valued area, just because insiders have, they bought when the stocks were depressed, and now, if anything, they're starting to take some money off the table. So we think that kind of big the financials have been rallying over the past few weeks. We think that's kind of going to lose some steam here, probably only because it's gone up, had a nice run. And, as we head into 2024 in the U.S., I think you've got this push and pull now. You're going to have some people concerned about recession, and if that's the case, oh boy, look at, that's not going to be good for the broad indices, never is. However, if things are going to be stronger, and we would kind of lean into that. We're not really in the kind of recession's coming camp. But if you're going to have a stronger economy led by increased government spending, because the U.S. deficit is substantial now, it's going to be somewhere probably between 5%, maybe even up to 8%, depending on how the economy goes, of the GDP in 2024. It's a lot of stimulus, but that's going to be a headwind for valuations on all those expensive technology stocks if the bond market starts to sell off. So we think the U.S. market is going to have some challenges in 2024, thanks to basically the good run it's had. A lot of good news is priced in, but if you don't get a recession, you're going to get some interest rate headwinds on the long bonds. Even though the Fed is we expect they're done on the short rates. So like the overnight rate, that we don't expect that to go any higher, but the Fed doesn't control sort of the 10-year yet, or 30-year. Maybe one day they'll come back in and try and control that. But right now they are showing every indication that they're ready to let the market kind of decide the rates for the longer end. So that is actually, though, that combination of lower short rates and let the market decide the higher rates is actually a good environment for Canadian resource stocks. So I would expect, if this scenario plays out, 2024 will be a much better year for Canadian resource stocks, Canadian, in general, than 2023, and we could get back to when we should get back to a scenario where Canadian resource stocks can outperform U.S. stocks. So we'll have to see.
We'll have more with Ted Dixon right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, so how did Canadian stocks perform in 2023, and how do you think they're going to do in the new year?
Right. So 2022 was a good year for the Canadian Insider Index, but it's kind of consolidated in 2023 thanks primarily to the energy sector. So it's up a little bit as we head into the end of the year. We'll have to see if it can get into double digits. It doesn't look that way, but you never know. It really depends on what happens with energy stocks in the final week of the year. It really comes down to that. So let's just call it a year of consolidation. But as I mentioned before the break, we expect the Fed is done in terms of its interest rate hikes. That should cap the U.S. dollar. If we can get a lower U.S. dollar, then that is a really, really positive for Canadian resource stocks, and that should be a nice tailwind for Canadian resource stocks. So from that perspective, it's positive. Looking at sort of the another major factor here that kind of emanates from the U.S. Is that U.S. government spending is going to continue to be positive, we expect. So what that means, we could have a lower U.S. dollar, but when you look at what is happening in the United States, they're spending, say $800 billion this year on defense, and they're also going to be spending, annualized in their fiscal year, $1 trillion on interest rate payments. That's a lot of money going into the economy. And, some of that interest expense money will get circulated back in the financial markets, but I think you're also going to see some of it, be spent by wealthy Americans. And that's going to create demand, keep economic activity up, which is good for resources and, industrials and the like. And this defense spending, we could be in for a surprise, I guess, if the Republicans hold the line and not fund Ukraine. There's some Republicans that want to fund, the Ukraine war effort. There's some that do not. We'll have to see how that plays out in the new year. And it's hard to predict. I have to think on balance, though, that it's going to be hard for the U.S. not to give some more money to Ukraine's war effort, only because the stakes are so high in terms of the geopolitics of the matter. We'll have to see if one way or the other, the defense spending is still going to be, I think, elevated in the U.S. And that, again, I would say is inflationary. I know there's a lot of people who are thinking inflation's dead. We don't fall into that camp. Yes, it's obviously come down, but when you still have this war economy dictated by geopolitics, then I can't see us going back into a deflationary Bernanke-style period. I just don't see that in the cards. So we would take the other side vigorously. We would take the other side of the inflation is dead mantra. Now, look, if we can get the peace process going with Russia in Ukraine, and we can get the Middle East conflict, this dreadful Middle East conflict, settled down and get a peace process going there, that's a different story. But we're a long way from that. Let's hope that's what transpires in 2024. Early in 2024, but I expect instead we're going to have heightened geopolitical conflict, which is again going to put pressure, I think, on the underlying fundamentals for resources. So you have a lower U.S. dollar, you have a juice government spending, and that combined should be pretty good for the fundamentals for Canadian resources heading into 2024. Now we've just upgraded the energy sector. We did that in our December 11th Canadian market report. And by the way, Jim, I just want to make a note that we do have a very rare special over the Christmas, early New Year period for those who want to join the Canadian Insider Club, so they get access to our market reports and our daily morning reports and our top 40 reports. You can use the code if you want to join the Canadian Insider Ultra Club. You can use the code SAVE24 and you get $150 off. So I just want to put that plug in there right now before I forget. But as we head into 2024, we've already upgraded the energy sector. I think a lot of that, is based off of seasonals. There was a lot of despondency about the energy sector, but we've seen this movie play out before late in the year, and a lot of it is seasonals. That there's some tax issues with inventories. There's an incentive for American producers to get their product out into the market before the end of the year. We will see where what happens to the energy prices here after this plays out. We don't see anything in insider activity that would suggest this weakness has been anything other than really seasonal. Yeah, maybe there are some fundamental changes after COVID, and maybe people aren't driving to work as much, so maybe demand is not quite as strong as it used to be. And yes, U.S. shale production has increased, not as much as some of the headlines I think suggest, but we've got growth growing in other parts of the world. So on balance, I think sentiment probably in terms of the broad investor market, broad market in the energy sector, by investors generally, got overdone on the downside. Insiders bought the dips. Suggest to us that look, we may not be going to massive big rally in oil. I don't want to put a price target on what it could be, but I just think the sentiment just got overdone here in the fall, and I think that the demand for oil is still pretty strong.
Now, Angola has decided to bail from OPEC because of their production restrictions. Is that the first crack in OPEC, and what could that do to the oil markets?
To be honest with you, I'm not sure I have a very granular answer to that. Except I don't think Angola has been a key player in all of this.
No.
I mean, it really depends on, I think, at the margin, the big players are Saudi Arabia, United States, which is not a member of OPEC, just based on we know what their production is, and also Russia, part of the OPEC Plus. And Canada's supposed to actually pick up in production in 2024. I think a lot of that is the oil sands. That's kind of a one-time leap up from what I understand. We'll have to see how that plays out. So you're going to have some supply issues. But to be honest, I think that it's sentiment that's driven the market down, and with some seasonal factors. And look, we don't need a huge rally in the oil price for a lot of Canadian energy stocks to do very well in terms of cash flow generation. Now, there is one headwind that keeps kind of blowing from Ottawa over the oil patch, right? I mean, if one or two. One is this constant insanity with the Trudeau government's but just energy, climate change policy. Look, Jim, for what it's worth, yes, I'm a supporter of dealing with climate change. That doesn't matter much, my opinion, but let's do it smart, right? Let's be smart about it. Destroy our energy sector as we deal with climate change. And you've got an energy minister who says he's a proud socialist and, wants to basically dismantle the Canadian oil patch. Well, he should get lost, okay? The Canadian energy sector is a critical component of our economy. And you don't play Russian roulette with the Canadian oil patch, and the Trudeau government really has to give itself a shake in 2024 and stop this nonsense. And then we've got this ongoing pain with the Trans Mountain Pipeline expansion. And I just read there's another rule that the regulator, the bureaucrats have said, no, you can't use this smaller pipe. And and now we don't know what that's going to mean. I mean, I'm doing this interview, I don't know what it means. This is just insanity. That we have these bureaucrats who get paid too much money to do too much damage, and it's just enough of this. So, as upbeat as we are on the basic fundamental outlook for the oil patch, Canadians are our own worst enemies. It is, when you look at sort of how Canadian productivity moves over the decades, how wealth moves per capita over the decades. I hate to tell you this, all you policy wonks in Ottawa, who work for the Trudeau government, but a lot of it is driven by how successful the Canadian oil patch is. So give your heads a shake and stop this nonsense. Stop it now. Like, we've had enough of this ridiculous bad policy assaults onto the Canadian oil patch. And I don't even live in the oil patch. I just, it's just common sense. It is a wealth generator in Canada. We need wealth to pay for government programs that, all this dental care, all this stuff, that the governments love to hand out, regardless of whether it's a blue team or a red team. Everybody, once they get into Ottawa as a policymaker, they want to do things that cost money. Right? So to do that, we need to have a vibrant energy industry. Yes, climate change has to be addressed, but let's be smart about it without yielding market share to Russia, to Saudi Arabia, to all these countries that are going to fill the void if Canada is not there, right? So it is just this. Let's just stop, please, in 2024. My one wish for policymakers in Ottawa is to stop this energy insanity. Okay, so that's a bit of a rant, and it is the Christmas season, so I'm trying to be upbeat, but I'm positive, I guess, that even as distorted the market can be in Canada because of these bad policy decisions, there's enough tailwinds for the energy sector that will allow us to kind of deal with any curveballs and tailwinds that headwinds that Ottawa throws our way. And we've also got a very good, I think, setup for the mining industry in BC, British Columbia, where if you're a junior miner, you've got your First Nations situation well managed. Well, you've got it on the path to including First Nations formally as part of your prosperity agenda for as part of your plan to get build your project towards a mine. Then you're probably in pretty good shape. When you look at, I just read, and I posted this on Twitter the other day, a junior who got an approval in Chile, finally, for its mine project, its environmental approval. Now, they started in April 2020 with their environmental impact assessment, and it took them over 3 years to get an approval, right? And so representative democracies around the world just really drag their feet and make it really hard for mines to get built, yet they're all trumpeting this energy transition. Again, it's just climate, just like tackling climate change in a way that doesn't make any real logical sense. But they want to move to, electric vehicles by 2020. By 2030, 2035, every jurisdiction has its magic date, but Western democracies make it very difficult to build a mine. Fortunately, in British Columbia, I would suggest that of all the representative democracies that I cover, that I've been watching, it is one of actually the better ones, where if you have, and the big if is if you have First Nations with you, then you have a pathway to development that has some certainty, which for investors is the big deal, right? The worst thing that you can have for an investor is not knowing how long or what the outcome of your environmental regulatory path is. So in BC, if you do not have First Nations with you, you will not get your permit. So there's certainty there, right? Do not ascribe a high value to a project that has no First Nations backing, right? It's not likely to get done, right? If your project has a definitive work-sharing, benefit-sharing agreement with all the First Nations in and around your project, right, then you're looking pretty good. I mean, that's kind of a general rule of thumb. Of course, you have to get into the details for each project. But, as in terms of sort of looking at it, even at the sort of 20,000 foot level, that's probably not a bad starting point. And if you've got your First Nations, you're really in a good place in British Columbia. And, as far as, comparing British Columbia to other mining jurisdictions. And, God bless Robert Friedland, he has been out championing the case for copper in 2024. He's been pounding the drum that it's not, basically it's not all about artificial intelligence. If we are going to do this energy transition, have all these EVs, build out our grid, we will need more copper. And, he had his case boosted significantly by, who would have thought, the government of Panama, who have, basically have caved in and decided they don't need copper mining in their country anymore, which is, their decision, but it's also taken, about 1.5% of the world's copper supply off the market. So we will see how that all plays out to the AI solves everything crowd next year, because AI is not going to find you more copper and get it out of the ground, in 2024. So we will have to see if the copper price, has a better year in 2024 than it does in 2023. The fundamentals are right now seem to be in its favor. Of course, we can always have surprises. If there is this global recession that everybody, not everyone, but a lot of people keep predicting, it doesn't show up. But, eventually we could, economic slowdown is never good for the copper price. But if you believe that, U.S. government spending is going to keep the economy, the biggest economy in the world, going, if you believe that China is, working hard to keep its growth engine going, there's going to be demand for copper, and the supply doesn't, seems to be getting more challenging, not more abundant. So we will see. Let's there's been many false dawns in the mining area, as I'm sure many of your listeners appreciate. But I'm cautiously optimistic for 2024. We'll leave it at that. And again, on the seasonal side, the energy area is looking good. Weaker U.S. dollar, but strong U.S. government spending. So, 2024, fairly upbeat about. It'd be nice if the folks in Ottawa would also help the cause, but I'm not holding my breath for that.
Yeah, I mean, it's a shame that they want to restrict natural gas. Now, all of a sudden, natural gas, just over the last few years, has now become an enemy energy source, and yet we don't have smoggy skies anymore, thanks to regulations and smog standards on cars. natural gas, very clean burning, but it seems that they would rather China build more coal-fired plants than use more of Canadian natural gas. Is that a frustrating thing? And no pipeline to Eastern Canada, so Europe could enjoy Canadian natural gas.
Well, and again, the irrational thinking of the Trudeau Singh alliance is that, well, we have to limit natural gas because there'll be methane leaks. Excuse me, but we're working on controlling those methane leaks in the pipelines. If we do not provide natural gas to Europe, who will do it? It will be, some other country, i.e. Russia. And yes, Russia still does supply the world with natural gas. No, they're not sending as many through pipelines, but they're sending LNG. Russia, who do you trust more to control methane leaks? Russia or Canada? I would put that to the partisans and the activists of the Singh Trudeau government. Who would you rather supply the world with natural gas? Is it Canada or is it Russia, right? And of course their answer is, well, we don't want anyone to use natural gas. Well, unfortunately, you don't have that choice. Because countries like India, are going to make their own decision, and you do not have any choice over that. And their choice is countries like Pakistan, they want to use natural gas. That is just a reality. And so, if you're going to be a policymaker, you need to ground yourself in reality. Right? And the Trudeau-Singh government has not grounded itself in reality. It is grounding itself in some make-believe world that if we don't provide natural gas to Europe via the East Coast, nobody else will, and all emissions will go down. Well, that is insanity, because the reason why it's insanity is because it is not reality-based. Reality is that Europe will get its natural gas from wherever it can at the cheapest price. It will get it from wherever India will get it from wherever it can, right? At the cheapest price. Europe will have some political constraints around it, which would have benefited Canada. But the Trudeau-Singh government said, no, we're not interested in helping you. Germany, we're not interested in that, right? No, go get your natural gas from the Middle East, right? Okay, who do you, Trudeau-Singh activist, who do you prefer to provide who would you prefer to sell natural gas to Europe to? Canada or a Middle Eastern country ruled by a monarch that isn't democratically elected, right? That's the reality. That's the geopolitical reality of the world right now. Not some wishful thinking, if we don't supply natural gas, then it will contribute to lower emissions around the world. No, the reality is just the opposite. It will likely require other allies of ours to source natural gas from countries that do not have the same commitment to reducing methane emissions as we do, right? That's the reality, okay? It is not reality to think that by limiting our export capability that we're going to be reducing global emissions. That is just complete fantasy, right? That's the difference. And when you're a policymaker, you have a duty to Canadians to be grounded in reality. How you approach that reality, yes, there are different ways to approach reality, but let's approach reality. Let's not live in fantasy. And that's the big difference, and that is my wish for our policymakers in Ottawa. Jim, our policymakers in British Columbia, I give them credit. And this has been across different governments. This has been a long time in the making from both the BC Liberals and the BC NDP, that they have developed a resource-based policy grounded in reality. And that is, some may not agree with how it's evolved, and that, it could be better this way or that way. That is up for political debate as to you should be doing it this way, you should be doing it that way. But it is grounded in reality. There is a recognition in British Columbia that we need copper for the energy transition, and that if British Columbia does not provide it, Indonesia or somebody else, will provide these metals that China, will provide battery metals for the world. So it is grounded in reality. Bravo, British Columbia. Ottawa, let's get back to reality, Ottawa. Let's, get with the program. I'm not all that optimistic, but that is my Christmas wish for this country, that our Ottawa policymakers should come back to earth as it is in 2023 and 2024.
Ted, again, Merry Christmas, Happy New Year, Happy Kwanzaa, Happy Hanukkah, happy.
Well, thank you, Jim. And again, I'd encourage those listeners to check out CanadianInsider.com, where we do have this holiday promotion. And either way, all the best to everyone, healthy and prosperous for 2024, onwards and upwards.
My guest has been Ted Dixon, CEO and co-founder of IncResearch.ca. Find his website is CanadianInsider.com. Find him on X at IncResearch. If you have any questions for Ted or for any of our guests, you can send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. Find us on X at Howe Street. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of Howe Street Media Incorporated.